Welcome back, accounting superstars. Thank you for joining me today to discuss investments. Now, accounting for investments can be quite tricky, especially since there's multiple different models that we use. Now, today we're going to look at the cost and the amortized cost model. There's also the fair value through net income model, fair value through other comprehensive income model. And then later on in LO 13, we will move on to strategic investments where we will use the equity method. So with strategic investments, those are the investments where we are investing in more than 20% of the shares. And so that is why we would use that equity method. So that will be touched on later. So let's just briefly define the cost and the amortized cost model, and then we'll go into a brief example. Okay, so the cost, the amortized cost model. So at initiation of the investment, or purchase is probably a better word, for the cost amortized cost model, I'm going to just move this over here. The purchase price is going to be the investment at fair value. Plus, we do add our transaction costs. To the purchase. Actually, I'll just put it here. Plus transaction costs. So if there's any cost to purchase that transaction, any kind of brokerage fees at all, then that would actually be added to that cost of that purchase at initiation. And you will notice that this is different than the other models that we'll get to later on. So dividend income, let's look at that next. And I should specify that for this, we are using, or we're speaking about investments in shares. So maybe I'll just move this over a little bit, and I'll also add in the cost model for investments in debt instruments. So this will be the debt instruments, and this one will be for the share transactions, investments in shares. Okay, so for the initiation, we have the investment at the fair value plus the transaction costs. Now for the cost amortized cost method for debt instruments, it is the same here. We have the investment at fair value plus the transaction costs. So we're going to add those. And then we will also have any accrued interest for bonds. So this would be if we purchase the bond at a date that's in between the interest dates. So let's say we get paid interest annually every January 1st, but then instead of purchasing the investment or the debt instrument on January 1st, let's say we purchased it on March 1st. Well, then we would have 2 months of accrued interest for that bond that we would need to add in there. Okay, so Oops, I didn't mean to cut that. I just meant to copy it. So let's put that back there. So this is our little summary. So if you're getting really confused with investments, I would strongly recommend to go through and make yourself a summary sheet like we are here. Okay, so dividend income. What happens with dividend income? How do we classify it using the cost amortized cost model? Well, we recognize it when there's a right to receive the dividend. So recognize when dividends are declared and not when they are distributed. So you may notice that dividends would be declared, let's say April 30th, and then they might be declared to be distributed in August. Well, we recognize the dividend income when they are declared. When there's that right to receive that dividend. Okay, and then for the debt instruments, we would recognize interest income and not dividend income. So recognize interest income. So here we would recognize dividend income, and here we're recognizing interest income. So just a different classification when you're making your journal entries. So for the shares, if we are purchasing shares in another company using this cost amortized cost model, then when there is a receipt to receive that dividend income, then we would credit dividend income, whereas in this method with the debt, we would credit interest income. So just a little bit of a difference there. Okay, and then what about at disposal? So at disposal, we derecognize the investment and report any gain or loss at that time. So there we would be crediting the investment account to remove it. We would be debiting cash to increase the cash account as we are selling it. And then if it's a loss, we would debit the loss account. And if it's a gain, we would credit that gain account. Okay, so what about investment in debt transactions? When the debt instrument is disposed of, we record any accrued interest and discount or premium to date of the disposition. So that's the first step, is recording any accrued interest and discount or premium. So let's say, going back to our example, that interest was paid annually every January 1st. Well, let's say that instead of disposing it nice and simply on January 1st, after having been paid that accrued interest, we are actually disposing it at a different date. So let's say we disposed it on March 1st. Well, then we would have those 2 months of accrued interest that we would need to record to bring that debt instrument to its accurate amortized cost. And then, or sorry, the discount, the discount or premium will bring it to the actual amortized cost. Okay, so that summarizes things there. Now let's look at a quick example. So we are going to go down here. Okay, so let's say Grace Co. purchases 1,000 shares of Chocolate Co. at $4.25 per share on March 8th, 2020. Okay, other details. 1.5% commission will be charged on the transaction. And on December 15th, 2020, the Chocolate Co. directors declare a dividend of 10 cents per share to shareholders of, I'll put it up here, to shareholders of record on December 31st, 2020, and payable on January 15th, 2021. Okay. So these two will tell us about our purchase. This next one will tell us about our dividend. And then this next one here will be the disposal. And that is on July 11th, 2021. Grace Co. sells 800 of the 1,000 shares of Chocolate Co. for $5.08. So you can notice already that they are selling, that Grace Co. is selling these shares for a higher amount there. Okay. And pays 1.5% commission on the sale. And then just as a note, Grace Co. has a December 31st year end. Okay, so a lot to take in here. So first, the step one is to record that purchase. So because we are following the cost model, okay, we're following this cost model here. Okay, then the investment is going to be at fair value plus the transaction costs. So let's start off with deciding whether we're using the cost or the amortized cost model. Okay, so we know that we have 1,000 shares and we are purchasing them for $4.25. Now we're using this cost model and it can only be used for equity investments under IFRS in which fair value of shares cannot be determined. Okay, so we don't actually know the fair value of the shares. It doesn't tell us, okay? So I'll just put that as a note. Since fair value is not known, we must use the cost model. Now, if the fair value was known, then we would want to calculate the fair value and compare it to our purchase price and determine if we were purchasing it at a discount or at a premium. So we'll look at that in the next example of the amortized cost. But since fair value is not known, we know that we use the cost model and we record it at the cost. Okay, so we can debit other investments since we are using this cost model. If we were using the amortized cost model, I would want to put investments dash amortized cost. So it's a really good idea when you're debiting your investments to actually state exactly what method you're using. So I could put other investments cost model, why not? Okay. And I know that I will be crediting cash. Okay, so step one is to record that purchase of investment. And so since fair value is not known, we're using that cost model. And how do we find out the amount? Well, the amount will be the price per share, which is $4.25. There's that price per share times 1,000 shares. Okay, so that's the actual purchase price. Now remember, we also need to add in the transaction costs. So in this case, we had to pay a 1.5% commission on that. So we will have to multiply this by 1.5%, which actually translates to 0.015%. So I always want to see your calculation there, so I'd expect to see it. And then I would actually want to see the number recorded in your journal entry here. .015. Sorry, I made a mistake here. I needed to have a 1 in front of this decimal point so that we're multiplying it by itself plus that commission expense. Alternatively, you could have multiplied the transaction cost by the shares and then also then multiplied that by 0.015 and add the two together and you would get the same amount. Okay, so 4313. I'm going to round it up to the nearest dollar there. Okay. Perfect. Okay, so that is the purchase. So, and I guess we should put our date of March 8th here. So that's to record the purchase of those shares. And if you wanted, you could write in your little description, purchased. Okay, the next step here would be the declaration of that dividend, which occurred on December 15th. So the dividend is declared, so we know that we have a dividend receivable, and we can record that dividend revenue at this date that it was declared. So let's just clear this up here. It says it declared the dividend on December 15th to the shareholders of record on December 31st, 2020. So it's saying that whoever owns shares as of December 31st, 2020, they will receive the dividend payable on January 15th. Okay, so because we know that this we'll have all of our 1,000 shares, we will have to pay, we will receive a dividend on all of those shares. Now, if we had disposed of some of the shares prior to December 31st, then we wouldn't actually have all of those shareholders of the record on December 31st. And and therefore then our calculation would be different, and we wouldn't have to multiply it by the full 1,000 shares. We would only have to multiply by that remaining 200. Okay, so let's do our calculation here. So it's 10 cents a share times our 1,000 shares, and that will of course equal $100. Okay, so let's do it there as well. Okay, so that is on December 15th, and that gets paid on January 15th. So on January 15th, then we will credit that dividend receivable and credit cash. Okay, so we know we're going to have to do that one, January 15th. So I'm going to put that down here. Oh, this one is for dividend declaration. And then down here we have, we'll have record dividend paid. So we know that is going to occur on January 15th. Okay, so then we would credit that dividend receivable because then it would no longer be owed. Now, there is a reason for why I put a space here, and that is because we have our year end in between that payable date. So our year end is, that would be step 3, which is our year end. So December 31st. Now, we need to decide if there is anything we need to record as at December 31st. So you will notice when we get to the other models, like the fair value net income, that we will actually need to make the adjustment in the investment account to make it equal to fair value. So we would need to do that at December 31st if we were using the fair value through net income method or OCI. However, we do not need to make any fair value adjustments for the cost or the amortized cost model. So let's just put a note, cost model and amortized cost model do not require the investment to be adjusted to fair value at year end. Okay, so that's a very good point to note, because that, if you can kind of remember the few differences, then that will really help you. So so let's put that here for information on our year end. Okay, that's not, okay. Okay, let's just put it here. Okay, so we have year end. Basically, do not adjust to fair value. And that's the same here as well. Okay. All right, we are cruising along here. Let's go back to our example. So at year end, we do not have anything to record. Okay, and then we already did our January 15th declaration or receipt of the dividend. Okay, and then we just have our disposal. So then here we have step 4 is our disposal. So then that disposal, if we go up to the example, let's see when it occurred. It occurred on July 11th, and we sold 800 of the shares for $5.08, and we also had, and we paid that commission. So we're going to have to subtract that commission. I'm almost finished. Okay. Oh Alrighty, so we know that we're selling the investment, so we know that cash is going to increase. We also know that the investment at the cost model, that is also going to decrease, so we're going to credit that. Now, we don't quite know whether we're going to debit or credit the gain or loss account yet. So you may be able to kind of jump ahead and have noticed that our selling price is higher than our purchase price, and so therefore we are expecting a gain, but we also have to account for that 1.5% commission. So we just don't know yet. Okay, but for cash, so our cash amount is going to be, actually, let's just write it right here. It's going to be $5.08. That's our proceeds times the 800 shares, not the 1,000. We're only selling 800. Okay, and so then that will give us cash proceeds of $4,064. Then from there, we want to subtract that 1.5% of commission. So an easy way to do that is multiplying by 98.5%. So instead of multiplying by 100, we're subtracting that 1.5% commission expense, and therefore we're multiplying that 4,064 by our 98.5%. Let's do that calculation here for our journal entry. Perfect. So that's our cash amount that we're receiving is $4,003. Okay, now our investment. What was our investment recorded at? Now, if it was any other model, I would do a T account on the side here and ensure that I have the correct amount. But because this model doesn't do any adjustments to fair value, we know that our investments are recorded on the balance sheet at $4,314. So that is the carrying value of those, so 4,134, I believe I said. That is the carrying value of all the 1,000 shares. So we need to multiply by 800 shares and divide by the 1,000. So that will ensure that we actually get the correct carrying value for the 800 shares. So that's 3,451. So let's put that here, 3,451. And if you find that your calculations put right beside your journal entry causing it to look messy, then by all means just put your calculations right below. Okay, so now we can see that our debits are greater than our credits. So to balance the equation, we will credit the gain on investment. And that will be the difference between our cash proceeds for the sale and the cost amount of our investment. And that equals 552. And so just as a little side note here, note that the gains and losses would be included in net income. Okay, so if we have gain or loss, they will always flow through net income. And so a gain will, of course, increase net income and a loss will decrease net income. Now, the reason why I point this out is later on when we're doing the investments using the fair value through OCI method, the unrealized gain and unrealized loss will actually go through other comprehensive income and won't go through net income. So that's just something to point out there. Okay, so we finished our example on the cost model using share for the shares, and we will next look at the cost amortized cost using debt in another video. Thank you kindly and have a great day.